All right. Hey, Ryan, how's it going?
Hey, great to see you, Lee.
So, we're doing this series of the HBS Online Course and going through the modules. And the first module is about finance. It's more specific, talking about how we track financial success in our organizations. And I couldn't think of a better person to bring on to talk about that than a bank CEO. So,
Awesome.
I appreciate you coming on and talking.
Glad to help.
So let's just jump into the questions. We have just two or three questions here we want to kind of get answered. And just from your perspective, running a bank, I know, you know, bank financials are a little bit different than other businesses, just based on the way capital is deployed, how equity is made or tracked. The financials are a little bit different, but so try to translate them to us, as much as we can. But let's talk about from your world, what financial measures does your organization use to track success?
So, I look at it actually different than a lot of my banking counterparts. I look at return on equity. So, how much money do we make for my shareholders? Their money that they have put in, and return on assets. Those two parameters, which more importantly, I kind of look at return on equity because, what did we make compared to what our capital is? And, I think that is one of the best barometers because, you know, shareholders, they've invested their money into you as a corporation. We're a bank, we're a corporation just like any other business. We happen to be a subchapter S. But we're no different than another business's way that's structured. We may have different liquidity when you take on deposits.
Mm-hmm.
That's going to be different. But when it turns down to it, we look at how much we made throughout the year in relationship to our capital.
Mm-hmm.
So that's what I look at the most. And then, we have a lot of assets. So we look at income in relationship to assets.
Mm-hmm.
So those kind of measures how far off they are and where does that, fall in line in spectrum with either peers or data. But I don't really look as much at peers as, is that a good return, just like any other business?
Sure. Yeah. One of the metrics that they highlight is return on invested capital. And I think in your world, that's return on equity. And I'll just
Yeah, almost one and the same, but yeah, go through the
Yeah, I
definition.
mean, I'll just cover it for a second just to highlight it. Talking about return on invested capital, and they use the formula net operating profit after tax, or NOPAT, divided by invested capital, gives you a return on invested capital. And they make the point to say one metric that's used to measure success is this, that measures how efficiently a company employs its capital to generate profit. So it's really about
Sounds exactly like return on equity.
yeah, it's return in your world. It's return on equity,
Yeah.
and then diving deeper into that, looking at what is invested capital. I think that's where it really starts to get interesting in your world because of how capital is used or leveraged.
I
In
mean, that was money raised to start a business or money
Mhm,
invested, whether
mhm,
got new shareholders or for a sole proprietorship.
mhm,
Did how much capital you put in to buy the equipment, the facility, the location, the software? How much money do you have at stake? If you've got, $100,000 at stake
mhm.
and you're making net 10%, is 10% a good return? Yes, no. 10% is a good return if it didn't, you know, if you weren't an active participant. No, making $10,000 a year and that's your full time job is a horrible return. But
Yeah,
if you were to just passively give $100,000 to someone else and you get a 10% return, by all means, yes, you'd be happy with that.
yeah, exactly. In large part during this module, I actually just finished it up talking about creating value and what does that look like, and how do you determine what value is to a customer or to a supplier. And they said they kind of gave this phrase or sentence to say that value is created when return on investment capital percentage is higher than the cost of capital. And the cost of capital comes in two forms: there's a cost of debt and cost of equity. um, and one from the investor, one from the interest rate on the debt. So value for the buyer is the difference between their willingness to pay, which is a lot of what we studied, and the price, and then the value for the investor is the difference between the return on invested capital and the cost of the capital. So with that, the next question I want to ask you is, do you use any non-financial metrics to measure success? Um,
Yeah, I do. Now, return on equity, return on assets, that's historical. That's what
mm-hmm,
you're doing either currently. So, how do you know what's going to be happening in the future? Are you going to continually hit that
mm-hmm,
return on equity? If you're happy with your return,
mm-hmm,
then what are some of the barometers to anticipate? Do you need to change? That. So I was thinking about that, and a lot for us as we're a bank, it would be retention of customers. So
mm-hmm,
if you've got a decay rate of customers
mm-hmm,
more so than that you're putting on, that would be a bad factor. Then you would see, okay, your return on equity may be
mm-hmm,
eroded in the future. So look at that. Efficiencies within your products, how you're doing, as you're growing, in my mind, you should be incrementally netting more as you're growing.
mm-hmm,
And, if you have more capital, you have more assets, then hopefully as you scale, you incrementally should be widening that profit margin, so kind of look at that. But employee retention, I think, would be huge.
mm-hmm,
Uh, and then, two, if you've got some known expenditures that you know are hanging out there,
mm-hmm,
does your capital do that? Um, our bank, we have everything on accrual status, so we know our return on equity is based in our expenses are already in there,
mm-hmm.
and future expenses, our payables, we've already got that factored into it. But a lot of small businesses, they may be doing well this year, but are you doing well enough to afford that new equipment that you have to have next year, or that new
Yeah.
roof, or that although those may be capital expenditures, are you truly making enough to cover your future costs that you know
Mm-hmm.
about?
Yeah, like advancing, building out your team, adding that new next team member that's going to take you to the next level. Investing in the things that can help you expand your current accounts. When you talk about retention, you have current key, maybe sometimes key accounts. How can they be expanded? What are the services can you offer them that they're not currently, you know, taking in? Um,
Once you're an established business and you've passed that, marker of,
mhm.
okay, we weren't making any money because we had to hire new employees, we had to get to a level of new customers to benefit that.
Yeah,
After that, as you're expanding, I just see businesses always think like, oh, we're investing in our future, that's why we're not making any money. Okay, well, I mean, you shouldn't be doing that for so long. Maybe
mhm.
you're investing in the wrong places.
Yeah,
You shouldn't have a continual downstream of income. You
hmm,
shouldn't have, oh, I'm investing so much that I have negative income.
hmm.
You know, you better have a strong plan, and there better be,
It better be very innovative.
yes, it better be. But I get to see the insights over the years of financing businesses, and
Hmm.
seeing that, and I can tell a lot of times when we do loan interviews, the business owners, oh well, we invested in our business. That's why we're negative. Okay, what did you invest in?
Where
Oh, you
where did that
made
go?
a lot of expenses. Did you buy things
Yeah.
that are going to make you produce faster?
Hmm.
Did you buy things to help reduce future employee costs?
Hmm.
To so
Yeah.
yeah, it's been fun. Really, that's what it's also helped me running the bank, is also being a commercial lender prior to being CEO of a bank, is seeing how everybody else has been running their business, and what they deem was important to them, and
Yeah.
which ones truly were financially stable and
Hmm.
profitable.
Yeah. You can't help but pick up all kinds of knowledge and wisdom talking to business owners and seeing them make mistakes and seeing them do good things, to not take that back and make your bank better. I mean, that's, you know what I
Oh
mean?
yeah.
I see you do that too. I mean, to that point and not to be missed. I'm glad I remembered.
Well, I remember the things I would preach to them, and also I was a commercial lender,
Yeah.
really early on. So I mean, I may have told them something and look at me like, okay, you young kid, you don't know what the hell you're
Mm-hmm.
talking about.
Mm-hmm.
So, then yes, when I'm in charge, you need to put your money where your mouth is.
Mm-hmm.
You need to say as I'm actually doing,
That's
and
right. Yep. Well, I wanted to mention too before we hang up is that it's awesome to have this conversation with you about return on equity, because the last 2 quarters straight you were number one in return on equity for all the banks in Florida. So that's pretty amazing. So we're talking to somebody who actually is doing, to your point, like, yeah, you probably had a aha moment back when you were younger to say, okay, now I actually have to do this in my business and not just tell people how to
yeah,
do it. And you've
no, I
done
mean,
it.
over the last 5 years, we've been number one in Florida. There's been ones and it's been
Mm-hmm.
interesting to see, like, we've been progressing to a
Mm-hmm.
little incremental and getting better and better. And the banks that have, performed higher on metrics throughout the years,
Mm-hmm.
at one time, boom, they had like one hit
Mm-hmm.
throughout that year. They did well. The next year they couldn't replicate. The next year they couldn't replicate. So they weren't like building on the same thing.
Mm-hmm.
So it's been nice to see like what we've put into place, the markets we've gone into. We've
Yeah.
been able to continually build on and get efficiencies and
Mm-hmm.
retain customers and build from those customers and expand with our
Mm-hmm.
customers. And so,
Yeah.
yeah,
Building in
uh,
these little profit centers.
yeah, absolutely. I mean, there's a lot of things that we can do as a bank, products to mix, and it's funny out there. Fintech. What is fintech? Banks are fintech. We're
Mm-hmm.
all always financial technology.
Mm-hmm.
So yeah, we're part of that ecosystem, and yeah, we're enjoying it. And on the best side is our customers are getting benefit and good things to say, and
Mm-hmm.
we keep expanding in there, and in our niche businesses. I mean, very rarely do we lose a customer, so that you know sure a lot of times that we've seen when we've lost a customer is because they sold a business or retired, and so that's been really great to see.
Yeah. Yeah. That's
Yeah,
awesome. Well, thanks for taking the time to have this conversation, and I'm excited about having this series go live here in a few weeks, as
cool.
we're
Looking
through
forward to
this.
watching.
And anybody who wants to keep talking to Ryan, reach out to him and talk more about return on equity, how to build your business. It's a great resource to go to. I'll link all his information below.
Cool. Thanks for having me, Lee.
All right. Thanks a lot, Ryan.